The interest that you all pay on loans that are of a reasonable interest rate really aren't that big of a deal in the grand scheme of things. And after you can get over me saying something so controversial, yet so brave, smash that like button and I'll explain why I said that blasphemous thing. So in a lot of ways, in the grand scheme of things, as long as you're getting relatively reasonable interest rates on items, and so for example, like mortgages, you're in the 2% range right now in 2021 at the end of 2020. A lot of folks are getting 30-year mortgages at 2.5 to up to about 3%. And if you get a new car, anywhere from 0%, which is fantastic, up to maybe like 3.99 or whatever. The interest that you pay on those things doesn't really matter compared to the price that you pay for the actual item. And there's been a lot of negative feelings about paying interest on stuff, and a lot of it I think comes from the folks, the debt-free movement, the Dave Ramsey types of folks that say that you should pay cash for literally everything that you buy. And why I do think that that's a good idea in a lot of cases, like for example, I wouldn't put groceries or utilities or candy bars or whatever on a credit card or something that's going to have nearly 25% interest. I think you miss out on a lot of opportunities in life if you only do cash. For example, you may entirely miss out on home ownership if you are a cash-only type of person. You may miss out on enormous gains in investments, be it investing in stocks, be it investing in some commodity or thing that you're interested in that goes up in value, like for example, luxury watches, perhaps collectible firearms, pieces of art, or whatever. You may miss out completely on buying investment properties if you are a cash-only person and say that any type of debt is bad. You may also make a mistake in purchasing a used vehicle for cash when you could purchase a newer, nicer, safer, more reliable either used vehicle or new vehicle with a loan and have a relatively low interest rate if you only focus on what the amount of interest is that you are going to pay for over the course of that loan. So the interest is in general inconsequential in my opinion, versus the cost of the items that you're going to buy. Because a lot of people will say, well, you're going to pay more for that item if you finance it. And that is simply not true. You pay the same amount for the item that you purchase. What you are doing is you're just purchasing an additional convenience of being able to purchase that item with somebody else's money and having the opportunity to do that either for the convenience factor and being able to use money that you have for something else like an investment that earns more interest than the interest rate you're paying on the loan, or you may be in some sort of an emergency or a need to purchase an item such as a reliable car to get you back and forth to work, or such as equipment for a business that you might want to start. Like for example, a lot of folks, if you were getting into like say excavation, may not have the $50,000 to $150,000 needed to purchase dump trucks and excavators and things of that nature. And so they may need to take a loan in order to start a business that will provide them a source of income. So what I want to look at is the two different costs that you pay when you purchase an item. And the one is the cost of the item. The other is the opportunity cost of using your money to purchase that item and how financing works so that you can get the item and you can keep your money in order to invest it and make more money in the end than if you would have just purchased and financed the vehicle. Now I keep talking about cars and it just keeps popping into my head while I'm filming this, because that's where most people usually draw the line on what they are considered to be okay to finance and what's not okay to finance. Most people don't have the money to purchase a primary residence with cash. It's hard to save up a couple to a few $100,000 in cash to purchase a decent residence. So even the Dave Ramsey folks out there are okay with taking a mortgage for a home as long as it's 15 years or less. And to be honest, that's a mistake as well. Versus taking a 30-year mortgage, you can invest the difference and end up with way more money at the end, as well as it being safer as far as having a lower minimum payment that you have to make every month versus the higher payment on the 15-year note. But we'll get into that down the road in this video. For now, let's take a $38,000 new car as an example. That is the average in the United States right now for a new car. Obviously, the best would be to get 0% financing, which is often available for new car financing. But let's say that you finance it for 3% for 5 years. The finance charge for that would be $3,000. And I know there's people out there on the internet like, $3,000. But that is only $600 a year or $50 a month when you start breaking it down into, smaller chunks. And that's not too terribly bad for access to $38,000 with basically no questions asked. I mean, I think most folks out there behind the lens here have taken an auto loan and they basically are just like, do you have some income? And they write it down and there's very little verification. You roll out of there with the new car smell and it's not a big deal. So there's basically 4 ways that we can work this new car purchase with financing or cash or whatever. You can have no money and not finance it, and you won't get a new car. That's just it. If you do, the good news is you are going to probably have 3 hots and a cot paid for by the state, and a bunch of your friends in prison for about 5 to 10 years until you can get out on parole. The second way to get this vehicle is if you have no money, but you do finance the car, it's going to cost you $41,000 altogether with the $38,000 for the car plus the $3,000 in the interest, and that's just what it costs you. Now, if you just don't have any money and you do need a reliable vehicle, I would say look for a reliable used car. But in this case, like if say you need to get to work and you just got out of college, you landed your $200,000 job that you got with your MBA, and you need a nice, reliable car for the 90-minute commute that you have to and from work 5 days a week. This is a reasonable way to do it because you're making so much money and you need this in order to get to work every single day. The third way to get this car is to pay cash. So you pay your money, it's only $38,000, there's no finance charge, but you've paid the cost for that car and you've lost the opportunity of that $38,000 because you have spent it on the car. The fourth way is to finance the car, invest that money. You do lose the cost of the car. So the car still costs you $38,000 over that 5 years, but you get to keep the opportunity of the $38,000 that you have in your pocket. In exchange for that, the bank is going to want about $3,000 of interest over that 5 years. But when we look at it with the math of how this works out with investing your money, that $3,000 really isn't that much of a concern. If you finance that vehicle and you invest that $38,000 into our benchmark index fund that returns 10% annually, at a fairly predictable rate, you would end up with $61,199.38 in that investment account after 5 years. Now, you would have had to make your payments on the car. It would still cost you $41,000 in payments on the car, but if you minus that $41,000 that you paid for the car plus the interest from the $61,199.38, that leaves you with about $20,000 in the end, ahead of the other options. And financing and investing your money is the only way that you are going to be able to purchase something and have money left over in the end. Otherwise, you would have just spent all of that $38,000 in cash or all that $41,000 with simply financing. Now, when you look at that at the end, you're only coming up with $20,000 on this vehicle, so it did still cost you money. However, the difference between the cash amount of $38,000 and the $20,000 that you have left over after purchasing the vehicle with financing and investing that money is $18,000, which means that essentially the net cost of your $38,000 new car and the convenience of not having to take your money and put it into something else is only $18,000. The upside is that while you had that vehicle and you were paying the payments on it and this was growing, if something else would have happened in your life, if you would have needed that money for something else, if a real estate deal would have fell in your lap, you would still have had that $38,000 plus whatever interest that you could have invested into something else that maybe would grow more than the 10% for the index fund, or maybe you had some emergency that comes up, like, an unexpected medical emergency, you needed a roof put on your house, whatever the case may be. In addition, we only looked at this from the 5-year time frame that you would have financed that vehicle for. Had you financed that vehicle, paid it off, and then continue to let that $38,000 compound over time, it would grow to far larger than the original $38,000 plus $3,000 for the finance charge, and you may be able to purchase your next vehicle out of the same pot of money that original vehicle originally came from. Now, I mentioned houses before and the 15 versus 30-year mortgage term. The same thing happens with this. You are much better off paying the interest and financing that over a longer period of time because you end up with several $100,000 more in the end. Let's just real quickly take a $300,000 average home in the United States. One is on a 15-year note at 2.5%. The other is on a 30-year note at 2.875%. I think that is fairly accurate for the beginning of 2021. The 30-year payment is going to be $1,244.68. The 15-year payment is an even $2,000. There is about a $756 payment difference between these two. The total interest for the 30-year mortgage is $148,000. The total interest for the 15-year mortgage is $60,000. So right there, people, you save $88,000 by going with the 15-year mortgage versus the 30-year mortgage. So it's a no-brainer. Obviously, we're going to save almost $100,000. But if you invest the difference, which you're going to be paying anyway with the 15-year note, if you invest that difference for the 30 years that you're going to be paying on the 30-year note, you end up with a total of $1.64 million in investment account, again, considering the average 10% return in an easy-to-invest index fund that anyone can do. I know what you're saying to me. You're like, well, but I'll be done paying off that 15-year note earlier, and I will be able to just invest that entire $2,000 for the remaining 15-year term of what that 30-year term would have. So I did that math. $2,000 invested per month, so $24,000 a year for the additional 15 years to make that 30-year span, leaves you with an account of $838,000 after 15 years. That is an almost $800,000 difference. If we subtract the difference in the total interest paid from the 30-year mortgage and the 15-year mortgage, you end up almost $250,000 better off after 30 years. So the issue, guys, isn't really the interest. That's not a big deal as long as you guys are getting interest rates at a reasonable level. Obviously, for cars under 3%, for homes right now in the 2s. What you really got to think about is, do you really need or want this item to pay the cost, to pay the interest, and have you considered the cost of it versus the opportunity cost that you are going to lose in the future if you pay cash for something and don't take a loan on it? Obviously, if you don't have the cash for the items that you're looking to buy, as far as like cars or toys or whatever, you need to really think of, should I save up the cash for this first? In my opinion, yes, you should save up the cash for cars and toys and things and then finance it to let your money grow. This is how wealthy people get and stay wealthy, by borrowing on things that they can get low interest rates on and letting their money work in markets and work in investments to grow over time so that they're not constantly trading their time for money. Guys, if you like this video, be sure to smash that thumbs up button for me. That really helps me out in the YouTube algorithm. If you haven't subscribed yet, hit that subscribe button to grow your wealth, increase your success, put you on the road to financial freedom, and we have a pretty good time here as well. I appreciate you guys watching me today, and I'll see you on the next one.